Hey guys, what's up? Alec back with the daily stock market, and look at that. Intel down to $37 per share, and it's fallen 31% in the past year. It's also at a multi-year low. So let's talk about Intel. What this video is going to be about is 5 different value stocks. And in this video, we're not going to talk about generic value stocks because the market has sold off so significantly. We have a lot of different stocks falling in value territory. So this is going to be 5 stocks that are undervalued in an overvalued market. And we're starting off with Intel at $37 per share. We can see that 52-week low is closer to $34, $33 per share. And we want to be buying under $35 per share, me personally. Now, from highs just about a year ago, they've fallen around 44%. Intel, as you know, they design, manufacture, sale of computer products, technology, and it does a lot of chip manufacturing too. We can see right now that the PE ratio is a 6, implying that it is extremely undervalued. It also has a dividend yield of 3.7. So this is a stock that could have been in the last video about dividend. It also pays that sweet dividend of 3.7. Now, if we jump into the financials, we can see that the net income really isn't growing, but the good thing is they're still doing $20 billion, $19 billion in just net income in the last 5 years on average. If we go over to total revenue, we can also see that they're doing $79 billion in total revenue. So they have a good net income to total revenue ratio. So as you can see, they're definitely not a growth company, but they are a stable company doing a healthy amount of revenue, and from that revenue they're getting a healthy amount of net income. If we scroll down to the balance sheet, what we can see is 43% liabilities to assets, which is really good. There's really no risk of Intel going out of business. They're not a dead company by any means. We can actually see that their total assets are $168 billion, and their cash and cash equivalents alone are $28 billion. Their total liabilities are $73 billion. Between their cash and cash equivalents and short-term investments, they can easily pay that off if needed. If we look at some other metrics, we can see that the PB ratio is 1.5, the PS ratio is 1.9, the free float market cap 155 billion. Okay, and if we go over to the right more, we can actually see that the forward PE is a 10. Now, a good alternative to look into is AMD. They're more about growth instead of value investing. So if you're more of a growth investor instead of a value investor, AMD is going to be a good one to look into for you. And you can also compare AMD's growth against Intel's growth. But they're both down 51%. So personally, I'm leaning towards Intel more as a value play and AMD as the growth play. Okay, well, so we'll continue to read. Recent corrections have brought Intel stock obviously to a 52-week low. Actually, further than that, valuation is so contracted by investors not only are paying for the chip business at a discount, but also getting the foundry business for free. Its acquisition of Tower Semiconductors will provide direct access to a chip foundry, and it also has officially acquired the land it needs for the Ohio manufacturing plant, which no one's even realizing any of the acquisitions or the land for new plans and things like that also. So other catalysts and risk for INTC: several of its new segments all achieve record quarterly revenue and report rapid growth. In particular, INTC has tapped Goldman Sachs, GS, and Morgan Stanley, MS, to lead the IPO of its Mobileye segment, according to a report. Mobileye could be valued as much as $50 billion, and INTC paid $15 billion for it about 5 years ago. The IPO could provide further resources for INTC to pursue high growth and high margin areas. Finally, risks. As aforementioned, the White House pledged $52 billion toward building America's chip industry, but there are uncertainties about the act passing. Last month, Senator Mitch McConnell threatened to block the act if Democrats pursue a broader spending package. INTC might have a delay or scale back if the CHIPS Act does not pass. So overall, I think INTC is a healthy a value play right now, especially if you can get in under $35 per share and you plan on holding for long term. Remember, if you're a value investor, you typically want to hold for at least 3 years to 5 years, so you have more of a long-term mindset than something like a growth investor. So with value investing, you really don't care what the stock's doing in the next 3 months, 6 months, 12 months. You really want to buy and hold for long term. And in my opinion, Intel is going to be at new all-time highs again. I think we can see at least a 50% to 100% gain in the next 3 years for Intel. And if you want to make shorter term predictions, I think we can get back to around $45 per share, which would be around a 20% gain on Intel in the next 12 to 24 months. Okay, so the next stock up is a stock that you wouldn't think would be on a value stock video, but it is getting to value stock levels, so let's talk about it. Obviously, there is a bunch of risks with any China-based stocks. BABA, ticker symbol BABA, is probably one of the biggest China-based stocks and one of the safest China-based stocks. So if you want to diversify a little bit into the China market, personally, I don't go anything over 5% total in the international markets. So BABA makes up a small percentage of my portfolio. Personally, I keep my portfolio diversity on BABA stock around 1 to 2%. So Alibaba at $120 per share is currently a good deal. You can see at the max chart, it IPO'd in 2014 at $93 per share. So if you get in under $100 per share, which it was $90 back in May, you're pretty much getting in at IPO prices. Now, you probably think of BABA as a growth company because you can see the extreme growth and revenue that it's had. But in 2014, remember, it's basically the same price it was in 2014. It was doing 52 billion in revenue. Okay, probably even less. Probably like 20 billion in revenue in 2014 when it IPO'd. Now it's doing around $1 trillion a year in revenue. If you want to be exact, 853 billion in 2022. And right now, BABA is only 30% higher than it was in 2014. Needless to say, Alibaba is extremely undervalued right now. There's obviously just a lot of fear with China-based stocks. People are fearing, can they take them off the stock market and take all my money with it? Usually they'll give you a heads up if they are going to be delisting a company, so you have ample time to sell it. But I think those fears should not be realized because at the end of the day, I don't think that's going to happen to a stock like ticker symbol BABA. If we go down to the balance sheet, we also see that they're in really good position, very, very low risk of going out of business. And how do we know? Is because we look at cash and cash equivalents of 450 billion in cash and cash equivalents. And if we scroll down to the total current liabilities, it's only 383 billion. So they can take all that cash and cash equivalents if they wanted and actually pay off all their total current liabilities, which is a great sign to see in a company. Very low risk of going out of business over the long term and high risk of rewards and growing revenues, growing free cash flow, net income. But let's look at their net income because unfortunately, their net income isn't growing like their total revenue is. So that is a question of what's going on and maybe why the market has beat them down so significantly. However, they're still doing 32 billion in net income, and last year they did 136 billion in net income, which is outstanding. If we pull back up, even if we go with that same theory of what was it in 2014, because BABA is pretty much trading at the same prices as it was in 2014. In net income in 2014 was only 23 billion. So it's still, the net income has still grown over the years comparative to the stock price. We can also see that their EPS has came in positive over the last 4 quarters. However, it has been declining, especially last quarter, Q4 2022. If we scroll up, we can also see that their PB ratio is 2.1. Their PS ratio is 2.4. If we go over to the right, we can see that the PE ratio is 33. However, the forward PE ratio is closer to 16. Here on BABA, we see that the stock has been declining for over a year and many investors have lost hope and capitulated. Although BABA hasn't lived up to my expectations, I see a path to strong returns going forward. There has been a few positive catalysts. Alibaba recently. Thesis: Alibaba continues to underperform on key metrics of growth and profitability, mainly profitability as we just looked at. However, the company is working to control costs, admin, and improving regulatory environment. So I believe that a turnaround is in the coming years and is more likely than not. The introduction, I've written about Alibaba a couple times in the past. I did a deep dive into China's e-commerce industry, and then in my article about Alibaba specifically, my last article was written in October 2021, when I argued that the risks facing Alibaba were overblown and that the company was too cheap. Since then, Alibaba has fallen another 20%. Unfortunately for investors, despite Alibaba's share price decreasing, it hasn't actually gotten cheaper by traditional PE valuation metrics. Alibaba fell below 20 PE last October, but now trades above a 30 PE after reporting low PS in Q41. Despite quite a few downward EPS revisions lately, analysts still expect profitability to bounce back. Alibaba trades at a forward P of 16, what we just looked at. This is cheap relative to Alibaba's 5-year sales, compounding annual growth of 40%, and its historical average PE ratio near 30. All right, so it's basically 50% cheaper than it typically is. So if Alibaba delivers on analyst forward EPS estimates and maintains its PE ratio, it could more than double in the next year, meaning that it has to have those profitability quarters. So profitability is going to be a huge thing looking forward on Alibaba, and they have to hit those analyst expectations. BABA also retains a strong balance sheet and returned about 4% of its market cap last year to shareholders through share repurchasing programs, which is amazing and a great thing to look for that companies do. That's a high yield for a company with double-digit growth potential. They plan to continue these repurchases going forward. Positive catalyst coming up. Another positive catalyst comes from BABA's expansion into Southeast Asia. Alibaba continues to underperform SEAS, ticker symbol SE, with growing a 32% compared to Shopee's 71%. However, I believe that the region's fast-growing e-commerce industry will remain without a wide moat leader until one competitor builds a dominant fulfillment network. So SE is another huge one to look at. I know when Metaverse was all the hype, a lot of people were putting ticker symbol SE in their Metaverse portfolio. So that could be a good one to look into in the future. I have some shares on my Fidelity account of SE, so we'll definitely do a deeper dive on SE in the future. Subscribe with post notifications on if you don't want to miss out on that video. We'll also see that competitors build a dominant fulfill network similar to Amazon's in North America, all right, and ticker symbol MELI in Latin America. Alibaba's deep pockets and fulfillment expertise give a real chance to build the region's leading fulfillment network. I'm along both Alibaba and ticker symbol SE and don't know who will win, but at least in Alibaba's case, it's diverse enough that it doesn't need to win in this specific region to deliver shareholders the value that they're looking for. Perhaps the most important positive catalyst recently was the news in April that Beijing is planning to end its regulatory storm over big tech and give the sector a bigger role in boosting its slowing economy. Although the news was reported by Alibaba's own South China Morning Post, and it's difficult to trust these statements made by the government, so far it appears that the article was accurate. So that is something to always realize, the risk of Alibaba and any Chinese-based company, ticker symbol SE, ticker symbol JD, ticker symbol NIO, NEO, XPEV, Li. Okay, we don't know what's going on with the China government over there, especially because most of us are US-based or Canada based. And since they're based on the New York Stock Exchange, also, if the government, the Chinese government, decides that they don't want them on the New York Stock Exchange, or America decides that they don't want China on the New York Stock Exchange, it could be a big headache down the road if you own a lot of shares of this international market. That's why I was saying in the beginning of Alibaba, I only own 5% max in international stocks. I also own some African stocks and some Chinese stocks as well. So for the conclusion, Alibaba is far from a perfect company, and their execution lately has been mediocre. They've gotten no help from their government either. However, their leading market position hasn't changed, and there are many examples indicating that commerce and cloud leaders usually make good long-term investments. Alibaba forward PE ratio today is quite cheap, and while it's not guaranteed that the company will deliver on the analyst forward EPS projections and be as profitable as we want them to, the stock has a lot of upside if they can become profitable. So overall, I have price alerts set at $95, $100, $105, on $110, and $115, really when I want to start dollar cost averaging. But mainly I want my dollar cost average under $100 per share and closer to 95. I think if you could get in under $100 per share, it's an absolute steal for long-term value investors. You're getting a great PE ratio. Obviously, there is risks with this one, more than typical value stocks. That's why it's usually thrown in the growth category, but it's sold off so much that I believe that it is currently a value stock. Here you can see I have a very, very small position. It's not even a realistic position. Obviously, it's just a placeholder, but I am currently dollar cost averaging. You can see $10 a day. And it's only $10 a day, so once it goes below those price targets that we went over, I'll start upping it to $200 per day. If it goes below $100 per share, I'll be buying like 3 or 4 shares at a time and building a little bit larger of a position on BABA. And Meta, aka Facebook, is the last stock that we'll be talking about today. Otherwise, the video will be way too long. We'll also do a part 2 of this video and do 3 more stocks in the coming future. So make sure you're watching out for that video. Let me know if you want that video as soon as this week. But jumping into Meta platforms, and you might be surprised to see this on a value stock list and not a growth stock list. I would probably also put it as a growth stock, but right now it's falling into value stock territories, down 50% in the past year, and it's pretty much at a 5-year low right now. However, we want to see it closer to 150 for a 5-year low. All right, my position is fairly small. We have $10 reoccurring going into Facebook. We have a PE ratio of 12.9 to start things off. Wow, a company like Facebook, aka Meta, is at a PE ratio of 12.9. Market cap is under 500 billion. 52-week low is right at 154, which would be a more attractive place for me to be loading up. Obviously, I'm dollar cost averaging, and for long term, I think anything under $200 is great for 3 years of holding to 5 years of holding or more. Dollar cost averaging is going to prove most beneficial for things like Facebook. I think that this is one of the last times that we'll ever see Facebook under $200 per share, so that's why I'm trying to dollar cost average a little bit more aggressive and buy lump sum investments in Meta closer to $150 per share. Remember, they also have Oculus and WhatsApp, so if you believe in them growing those platforms as well, and the metaverse additionally growing as well, Oculus growing, more people getting Oculuses in the coming years, then this one could also be a good investment. Meta could be one of the riskier ones in this video, but it could also be one of the ones that pays off a little bit more. So let's see how it's performed in the past here. You can see the EPS over the last 4 quarters has been phenomenal. It's missed analyst expectations some quarters it's beat it, but it's reporting an average of like a 3 EPS, which is showing that's a profitable company. All right, if we pull out to the annual income statement, we can see that it's been gaining around 20 to 30% per year. There has been one off year there in 2019, but remember, we're pretty much getting in at a 5-year low right now. So if we look back at 2017, which was 18 billion in revenue, that's pretty much the same price that we're buying Facebook stock for right now. Remember, in 2013, which was about 9 years ago, they did 1.5 billion in net income. Excuse me. If I said total revenue, this tab was for net income. You can also see how it highlights which tab we're talking about. So if we move over to total revenue for the last 5 years, we are closer to 40 billion in 2017, yet we're getting Facebook for the same price today on the share price when it's doing 117 billion in total revenue. So you can see the difference. And if you pull out to 2013, you can see they were only doing 7 billion. So I would definitely give them a passing grade on their net income. They would probably get like a B, and their total revenue would also get a passing grade of an A. Now, if we scroll down to the balance sheet, we can see that they have a phenomenal balance sheet, okay? So they have very, very low risk of going out of business with this company. They have a 24% liabilities to assets. They could easily pay off all their debts. They automatically get an A+ on their balance sheet. If we dive in a little bit deeper to see what's going on, though, we can see that the cash and cash equivalents is 48 billion. Right? And if we go down to total liabilities, not even total current liabilities, if we just look at total liabilities, it's 41 billion. So with the cash and cash equivalents that Facebook or Meta has on hand, you can see the 48 billion. They can pay off all of their total liabilities. Now, something to watch out for is you see in 2020 they had 61 billion and now they have 48 billion, so they've been paying down debts. You just don't want to see those cash and cash equivalents keep getting lower and lower. You actually want to see it keep increasing, which it has done significantly over the last, 10 years. If we scroll down, we also want to look at the total liabilities and make sure those aren't going higher and higher. So we can see last year it was 31 billion, so they had more assets, less liabilities. Now they're taking on 10 billion more in assets year over year. So watch that number as we get more information on the balance sheet to make sure that the total liabilities don't keep increasing as well. You can see in 2016 their liabilities were as low as 5 billion and their cash and cash equivalents were closer to 29 billion, which is a really good ratio. And, needless to say, they still have a good ratio today. Their balance sheet's looking excellent. We just don't want to see it start going in the wrong direction. Same with the income statement and the net income and the total revenue. So I hope you guys really appreciate that video. Drop a big thumbs up on this video right here. Subscribe with post notifications on so you don't miss out on future videos. And if you want more information on my option trades and see when I'm buying, when I'm selling, the success rate, click on success number 5 on the highlight section of my highlight here on Instagram, and you can see that all the awesome success that everyone's been having. You can even go to the back to see the most recent ones, and you can see, can't post everyone in the group, $228 here, like always, up 48%, $272. We can see a WBA put we actually took out on Walgreens, up 82%. Even more students are making money betting on stocks going down before earnings. We also have a big earnings coming up in 2 weeks, 3 weeks, 4 weeks, 5 weeks. Earnings season is approaching us. We're going to be making more earnings videos, so make sure you're subscribed with post notifications on so you don't miss the earning video. But more importantly, message me on Instagram to get on that close friends list. I'm taking a few more people on the close friends list for the earnings season. We're going to be betting on a lot of companies going down this earnings season. And this next week, by the way, if you watch this far in the video, I think this next week that we'll see is going to be a red week for at least the next 2 weeks or 3 weeks. So that's going to be an interesting ride in the stock market. We're going to be making money in the close friends list, betting on stocks going down this month, all this month, the next 30 days. So it is a great time to join the close friends list. All right, guys, that was the end of the video. Share this video with a friend if you enjoyed it, if you think they'll find value in it. Like, subscribe, and I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.